Okay, welcome to another iteration of the Insight Education Series. I am Shana Harvey, President and CEO of Insight Total Stewardship, and thank you again for joining us. We have with us a guest speaker today. You know that each month I feature a different topic on our education, and because of that, sometimes I'm the person, and sometimes I actually bring somebody in. I'm trying to get this view right here. There we go. And today we have Paula Huhn, who's going to join us. She is a mortgage loan officer. She's the branch manager, actually, of Crown Home Mortgage. And she specializes in making the complex simple. So she will make sure that if you are looking to get educated on mortgages, to buy your first home, even just understand the mortgage environment right now, she's the one to do it. So I am going to shut up and give her full reign to do whatever she wants to do in this next hour or so. But we will have time for Q&A. So if you have questions, feel free to throw them in the chat. I will field the questions and give her an opportunity to answer those questions towards the end, or if you prefer throughout, whichever you prefer, Paula. But
I take them. It doesn't bother. It doesn't bother me to answer them as they come.
okay,
It's fine.
cool.
If I need to push it off till like a little bit later, I'll let you know.
All right, cool. And well, you should
Awesome.
be free to share your screen if you like to do that. But
Beautiful.
take it away.
All right, let me just share this real quick. All right. So welcome everybody again. Shana said I am Paula Huhn. I am the branch manager of Crown Home Mortgage in the Philadelphia office. I have been in lending. I've been banking and lending since 2007 and specialized in residential lending since 2012. Shana, I want to say thank you so much for giving me this opportunity. I love educating anybody in this market because there's so much bad information that goes out there. And the way information gets interpreted can lead people into bad financial decisions. So what I've done today is I kind of wanted to give you guys what the forecast was there was going to be for 2023. We're halfway through the year. So there is some of the information that I've updated in this presentation. As a loan officer, I have to keep abreast of all the things that are happening in the marketplaces that affect mortgages and housing. And we have all heard the I word, inflation, and R word, recession. And what we're going to talk about today is how those things are going to affect mortgage rates. And then we're going to talk about different ways of, should you wait? Should you go now? What is the cost of waiting to buy a house? Because we have a couple different things happening in the market right now that are kind of contradictory. We have high rates, but low inventory and high home appreciation. Which, by the way, home appreciation is a normal thing. The prices for homes going up and increasing every single year is on average between 2 to 3% a year. So there's only been, I think, 3 times in the last 50 years where homes have depreciated. And the most that they depreciated was a little over 1.5% in the 80s. So that's including the housing crisis of 2006, 2009. So you keep that in mind and thinking, oh, house prices are too expensive right now. Once you keep that back in your mind, that real estate is actually a wonderful investment. It's a long-term investment because houses do appreciate more often than not. And if they do depreciate, it's not for a long time, and it's usually not that significant. All right, so what we're going to talk about right now is the inflation, right? So we've all know inflation right now is very, very high. What this chart does is kind of give you an idea of how it relates to the mortgage rate. Now, typically, mortgage rates follow the rate of inflation. So if inflation is going up, mortgage rates are going to go up. If inflation goes down, mortgage rates are going to go down. And you can see that in this history from 2018. That's kind of what it did. These two lines, this is the mortgage rate line. I don't know if you can see my pointer. And then this is the consumer price index, which is kind of like the guideline of inflation minus food and energy. We take out food and energy in that because a lot of times the weather and other things can affect that. That is not based on any like government regulations or there's nothing the government can basically do to stop a flood or something like that. So that's why we take that out when we're trying to measure the rate of inflation and the consumer price index, which you'll hear it throughout the news, the CPI and things like that. Now you know, CPI is the consumer price index. So this kind of mirrors where interest rates are going. Now, a lot of people don't realize that prior to COVID in 2020, we actually were headed into a recession. In the early months in February, we had a big dip. I think that's about right here. A big dip in mortgage interest rates, and as well as a big dip here. Whoops, sorry, hold on. I go back. How do I get back previous? All right. As well as a big dip in mortgage rates, as well as a big dip in CPI prior to COVID. This is all prior to COVID. Now, once COVID happened, and when I say COVID, I mean once we were all quarantined. Okay, so think March and April 2020. The Fed started doing something called quantitative easing. And what that means is basically they started buying mortgage bonds. Now, when you think the Fed, you think of that interest rate that everyone's talking about, right? Well, just so you know, when the Fed hikes interest rates and you see that headline, that doesn't equate to mortgage rates. Mortgage rates, believe it or not, are really rarely affected by the federal funds rates. What is affected by the federal fund rates is your credit cards, your car loans, your savings accounts in banks, CD, certificate of deposit accounts in banks, because that's the rate at which banks can borrow money from the Fed. Okay, so mortgages really typically are not affected by that. We're going to talk a little bit about that later. But right here, the Fed did come in and they did buy mortgage bonds. And by buying the mortgage bonds, it kind of held the interest rates, as you can see here, for a long time. Now, do we want to have some participation? Who knows what kind is going on right here where my pointer is? If no one's into participation, that's fine. I'm not going to force it. So if you notice right here, the CPI starts going up, right? And a higher CPI, that means a higher inflation. That means cost for things is getting more expensive. And this happens almost in the middle of 2021, right before the middle of 2021. But since the Fed is holding back those rates by buying all those bonds, there's a big discrepancy right here between the interest rates and the CPI and inflation. It's not until the Fed decides in January of 2022, last year, to stop buying the mortgage bonds that we see a sudden increase. I'm going to minimize that. The sudden increase in interest rates, right? And we all felt that. We felt that going in here. Now, at the end of 2022, there was a slight dip in the CPI, which, as you can see here, the mortgage rates then follow. Okay, so that kind of gives you that history of, okay, well, what happened in the past year and a half? What happened during COVID? Why were rates so low? This is why. This is why rates were in the threes and below threes. It's because the Fed were buying the mortgage security bonds. So your friends and family members who boast about having a super low interest rate, this is why. Okay. And if you're thinking about buying a rate or buying a home or refinancing or doing anything right now with your home, that's why the rates are so high right now, because inflation is so high. There's more to it than that too. So with all that information, okay, great. So if rates drop when inflation drops, when is it going to drop? When's the peak? Well, that's a little bit more complicated to predict. What CPI is calculated based on is a 12-month running average. And what they do is they round some numbers up. End of last year, CPI was at a 6%. Okay. I have more current numbers here. This is where we currently are. It's a little bit over, this is CPI without the food and energy. You can see it's a little bit under, or a little bit to 5, almost 5. So it's a little bit over 5% right now. Okay, so it is going down. And that's because as we go through the year, these high numbers over here are all going away, right? So when we get the next Fed meeting, or the next CPI report that comes out July 26th, it's not going to include this number, this June number. So we expect that the year over year CPI rate to drop down to 5. Now that's a good thing. It's a good thing because what's going to happen is the rates will follow. Okay. July, when we get the CPI rate in August, it's probably going to be a flat because July last year was so low. But then in September, it's going to be lower because now we're getting rid of this number right here, this 0.6 from August. Okay, and so we're going to be replaced with the new number. So what that means is, the trend is eventually rates are going to go back down. This is another thing. This is what actually has a correlation to interest rates, the 10-year treasury. Okay. So the 10-year treasury for the most part is the 1-to-1. So this line right here is the 10-year treasury line. This line right here is your 30-year fixed mortgage rate. It's typically 1-to-1. So if it was 9% up here in 1991, which that is an actual rate, it would be 10% or a little bit over 10% for a 30-year mortgage. It's 1% difference. But there are some times, as you can see here, that it goes higher. So right now, there's a huge spread, a big difference between the 10-year treasury and your 30-year fixed mortgage. Okay. That's really weird. Why is that? So because the spread is so large right now, is because once those rates started to go up and rise, the buyers of these mortgages. So when you get a mortgage, right, and you go in and you say, okay, I'm going to get this mortgage through XYZ Bank. Most of the time, you're going to get a letter shortly after that says, great news. Your loan with XYZ Bank is getting sold to ABC Bank. That's your new servicer. That person has bought that liability, that mortgage, paid XYZ Bank some money for it, and now they hold it. Now, these servicers and these mortgage-backed security holders, they need to make back the money that they just spent for the investment. So typically, that's going to be about a 5-year hold. Okay, most people keep the mortgages, believe it or not, between 5 and 7 years. I, amazingly enough, I'm a pure example of that statistic. I either refinance or move every 5 to 7 years. And I went back in my history on that, and I'm like, oh, I really do. It's hilarious. But within that time frame, most people refinance, and when they refinance that loan, that the servicer no longer has that investment. They're no longer collecting on that. That's a huge risk because what we're expecting is rates to do what? Rates to drop. We're expecting rates to drop, and if they drop, people who bought houses in the past 2 years at 6.5% or 7.5% interest rate, they're going to want to get a lower interest rate. They're going to want to refinance. So that servicer is going to lose all that money because they haven't held it for long enough. So they're really worried right now. So what they're doing is they're kind of hedging their bets. They're kind of saying, okay, well, I got to charge more because I know I'm not going to hold this debt long enough. So that's why that's why this spread is so much bigger than almost any time before, because the servicers are worried they're going to lose their money once people start refinancing. Oh, there's little lines there. Sorry. All right. So we talked about recession. We talked about inflation. Inflation comes recession. Okay. Once we go into recession, believe it or not, that's actually really, really good for the real estate market. Every recession, except for the 2006-2009 recession, has yielded an influx and a positive growth in real estate, believe it or not. And so what we want to look at is some of the data to show, okay, well, how do we know a recession is coming? Here's a really good indicator. So this is the personal savings rate. This is pre-COVID. Pre-COVID, everyone started saving money because no one could go anywhere. Then we get the stimulus package about here, and everyone has a lot more money to save, and they don't spend it because, again, there's nowhere to go. Go down a little bit, go into 21, we get another stimulus package the following year. The third stimulus package hit, we're saving money. Now the stimulus is over, COVID is easing up. You can see more and more people stop saving their money. Okay, it's almost like the more freedom we have to go out, the less money we have to save. You can also see the same thing correlates with the credit card balances. So in early 2020, credit card balances were pretty high, but then all of a sudden COVID hits and people stopped charging because, again, they had more saved. They could spend more cash rather than charge it. But unfortunately, going into 2022, it skyrockets. And right now, the credit card debt is skyrocketed so far over where we were pre-COVID. That means less people are saving money, more people are utilizing their credit card debt. And guess what? Remember I told you the Fed interest rates affect the credit card interest rates? The average credit card interest rate right now is 24%. That's a lot of money that is going towards your credit cards. Okay. So people have less spending money. This is another indicator of recession. This is your 10-year minus your 3-month bond rates. Okay. So a bond is basically just an investment. Okay. Your 10-year bonds are long-term. Anything that's a long-term savings is going to give you a higher interest rate back. You're going to get more money the longer you keep it in something when you're not allowed to take it out. Okay, so we compare the 10-year to the 3-month. Okay, because you can buy a 3-month bond. That's a shorter term. You're not going to get a lot of a return on that one. But it's not locked up for 10 years. Now, typically, the 10-year makes more money than the 3-month. But there are some times in the past, right here, right here, right here, and right here, where when we subtract the 10-year minus the 3-month bond market, you get a negative number. So here's our 0. It's in the negatives. Now, if you look at that, after that point, this gray box represents a recession. We go into the negative yield curve, go into recession. Negative yield curve, we go into recession. This long recession here is that 2006-2009 recession. This was that blip of the recession early 2020, right before COVID. We did predict that. We all knew it was coming. We expected it. And then COVID hit and it kind of changed everything. Here's where we are in the beginning of 2023, and it's still kind of holding true right now. We are really low. It is a clear definitive difference between the 10-year bond rate and the 3-month. Okay. What we assume right now is usually it's a lag between when that occurs and when a recession is actually called. It can be upwards of a year before a recession is actually called. And by then you could be in and out of a recession by that point. But we are clearly due for a recession, which is great news for mortgages because that means rates are coming. Rates are going to come down. So you might be thinking, great, rates are going to come down. I want to buy a house. I have to wait until we are in a recession. No, that's not necessarily true. I see we have a question. Yep, average recession. Yeah, average recession is only 9 months long, and most of the time people don't even know we're in it. So the cost of waiting. So there is a cost of waiting because although the rates are high right now, okay, homes are also appreciating. I mentioned that earlier. Homes are growing in value, and they grow in value all the time. That's what they naturally do. Real estate's a phenomenal investment because the likelihood is going to appreciate is almost guaranteed. So if you decided you were going to wait for the recession hit to even purchase a home, this is how much money you'd be losing. This is what you could lose out on, okay? If you bought today at 6.875, this is an actual home for sale in Philadelphia, and you bought it for $375. In 6 months, if you waited 6 months to buy an identical house like this, it would be worth $384. So yeah, you're going to have a lower interest rate, but you're missing out on that equity. If you wait a year, it's going to be worth 385. Again, you're missing out on that equity that you could be gaining. All right. This is compared, if you wait 6 months, the payment difference, okay, $175. Waiting 1 year, $170. The total cost of waiting, you lose $11,000 in 6 months. If you wait a year, you're losing $15,000. That's going to grow exponentially the longer and longer you wait. So although a lot of people think, oh, the best time to buy is when the rates are low, that's not necessarily true, because there's a couple things you can do when you buy a home. So you buy a home and you get in the house, you can do something called a refinance. And what a refinance does is it pays off your existing loan and you start a new loan. It's basically the same process that you do with buying a home, except you're basically refinancing it. You're getting a brand new loan that's amortized, or it's based off of 30 years, and you potentially get to lower your payments. Okay. So you could still, if you waited 1 year, hold on, let me go back. So if I bought a house today at 6.875, and a year from now, the rate's 5.875, I can simply just refinance my mortgage, get the discount in the monthly payment, but now I still get my $14,000 in appreciation because I own the house. Okay. Does that make sense with everybody? Just want to make sure we're all on the right page. Okay. So here's another reason why right now is a good time to buy. Okay. The housing demand. So housing formations are on a decline. Now, a housing formation, what is that? That basically means someone who is going to buy a house, average age is 33. So that's, the kids get done college, they're getting married, they're going to buy their own home. Now, what's happening right now, what we're seeing is a lot of people are putting that on hold because, again, the rates went up, they went, whoa, they put the brakes, right? And they're hibernating, they're staying where they are for a little bit. So the good news is right now we have a lower housing formation, but does not mean that they're going to decrease. Okay. We started before last year, we were at 1.75 million people who would be a potential home buyer. Now that's dropped, which is great, but there's not a lot of houses. Okay. Now, when we're talking housing supply, we're talking about new construction. Housing started completed at 1.5. That was not enough to cover that 1.75 million. Okay. Not to mention, we have people who go away from being a new household, right? So people who decide to rent, people unfortunately pass away. There's no new homes being built, or there's no new housing. So we have to have a replacement for the houses that have to get rebuilt. The total new supply is 1.4. Housing formations right now are 1.3. We're really not in a good position where there's a lot of housing. Okay. Builders are being really cautious. Not only did they get hit really hard in COVID with lack of supplies, there was a lumber shortage, which caused a lumber price increase, like almost lumber inflation, if you will. That prevented a lot of builders from getting permits to build new homes. And without new homes, to replace the houses that are already taken, or to help supplement the new home formation, we have a housing shortage. And that also boosts up the values of the home because more people are willing to pay a premium for the supply. That's natural supply and demand. So since builders are also very cautious, they don't want to start overbuilding. But thank goodness they learned from 2009 and 2006 and 9. We are not really in a bubble. Okay, there's not going to be a crash. Everyone thought in 21, 22 there was going to be this huge housing crash. This has been the appreciation for homes over the last 10 years. So over here, it's up 115% from the last years, from 2003. Here, it's up 39% over the last 2 years in 2020. We went down a little bit at the end of 22. So the home prices were down 2.5. Right now, according to Zillow, the average home price appreciation is 1.678. So homes are still appreciating. Homes are still going up in value. What we've seen earlier this year is we've seen people come back out from hibernation of not wanting to buy a home because they realize, okay, these rates aren't going anywhere anytime soon. It's going to cost me more to purchase a house if I wait another year. I have to get the house now. So, sorry. So that's my contact. So to that point of the cost of waiting, you want to make sure that you're not just waiting for that best deal, because the best deal is not gonna be there. We have a mantra we're saying right now in the industry, marry the house and date the rate, because you have that ability to refinance. It's a really good opportunity for you to actually get in the home of your dreams, as long as you can afford the payment. I say make sure you can afford the payment for at least 2-3 years. And if within those 2-3 years the rates drop and you get to lower that payment, great. Do that. Because then you're be in a much better financial position. Not to mention, in those 2-3 years, you're going to have some appreciation. The home is going to build what we call equity, which is the difference between the value of the home and the amount of loans you have on the house. And that equity can be used for a lot of great things. So when you build equity in a house, like I said earlier, real estate is one of the best forms of investments because it does appreciate over a long term. And it's almost a guaranteed appreciation of at least 2% per year. You can then tap into that equity as you build it to do other cool things. I mentioned refinancing to lower your payment. You can refinance to get some of that wealth that you've built, that appreciation, to do other fun things. You can use it to take a trip so you don't have to do a staycation. You can use that money to fix your house up, to add a pool, to redo your kitchen, to add an extension. If your family is growing and you don't want to leave and you want to stay in that house. It's up to you what you want to use that equity for, but that's what we call the equity in a property. You can use it to pay for college for your kids. You can use it basically for anything. You consolidate debt. If you find yourself being one of those people who, right now they're using more of their credit cards than they're saving, tapping into the equity that you built in your home, even if you bought 2-3 years ago, as I said, homes have been appreciating. Tapping into equity to pay off that credit card debt could put you in a better financial position to where you can start saving money. So rather than paying everything on your credit cards, without that credit card debt, you can just put that money into savings. And that's a smarter financial decision for in the future. I'm going to stop sharing. Does anyone have any questions about the interest rates right now? Any fears that they've had about that? And then I'm going to go into kind of like the mortgage process. Any information they may have overheard that they want to clarify.
I had a question, just because, I did think, okay, well, rates are high. Maybe you could just wait to make some of those home purchases.
Mhm.
But it's a great point. I guess I didn't know whether or not we were in a real estate bubble. And so I'm like, well, if rates are going up, then prices are going to come down, right? They have to, but
Right.
no, clearly they don't. So because they're
Yeah.
not coming down.
They're not
So
coming
yeah,
down
it
because
does
there's no
cost more to
supply.
wait.
Yeah. Yeah. There's no supply. And with that lack, and because here's the thing. So I'll share some of the statistics with you. 60% of homeowners aren't going to move right now because they have a great rate. Like they basically have to be forced to move. And some of the reasons that someone would sell their house right now, it's they're getting married and they're growing their family in some way, shape, or form. They're consolidating the family and they're going to a more multicultural, more multi-age family members. So like kids are living with parents again, grandparents. you have different levels, so they need a bigger house. That would cause someone to want to list and then move. A divorce would be another reason why someone would want to list their house. They don't want to live with that person anymore. Marriage, they buying their first home. So it's a very small, or not, it's a very small percentage of people that can list or should list. Relocation, business location. So we still have a lack of supply, and without the builders building the homes, we're still going to be in lack of supply. And remember, to build a home doesn't take 3 months. It's a 6 month to a year or more before those homes are actually built. So we are going to be in a shortage for quite a while. We've been in an inventory shortage since 2015, really. It just wasn't as bad. Like it was I wouldn't consider it even a seller's market. It was kind of flat, and where it was like kind of good for both. And then with COVID coming and the drastic changes with that, it just exasperated everything. So, until we get an influx of inventory, and hopefully we don't get too much inventory, the prices aren't going to get pushed down. They're going to remain the same. They're not appreciating at that 39% for sure, but they're more average. It's that 2 to 3% appreciation rate. And in some areas, in our area in Philly, it's more because, again, we don't have a lot of inventory, and the inventory doesn't sit. In East Falls, the average house is on the market for 7 days.
7 days. Wow.
7 days. Yes. It is crazy out there.
So if you're selling a home right now,
it's great.
You probably can get pretty good money. If you're buying a home, it sounds like it could be tricky because you may not have something to move into. So you got to be armed and ready with your pre-approval so that you can make an offer immediately if you're buying a house.
That is correct. And now that's a really good segue. I kind of want to go into the process of buying a house and what that pre-approval means and what you have to do. I don't have slides for this because it doesn't warrant slides. So it's really important that when you buy a home, or even if you're listing your home to buy a different home, if you need to step up or step down, the very first thing you should do, rather than talk to a realtor, a real estate agent, whom I love, think they're very, very smart at what they do. But before that, you need to get pre-approved for your new purchase. You need to know what your limit is, how much you need to buy a house, so that we can make that plan. Okay. If you are very well organized and you plan this out, it's really not that hard to sell your home and buy a new home in this market. Okay. So what I mean by pre-approval is there's different levels. What I like to do first is do a full pre-approval. And that's when I have an underwriter. The underwriters are actually the people who are going to approve and deny a loan. They say, okay, here's your story, right? That's your application. Here's your story. Show me the details. Show me your references, if you will. That's the things like your pay stubs, your identification, your bank statement. Show me the details that match up with your story, and I will let you know if that works, if that fits all the many guidelines that go into being allowed to do a mortgage. That's a true pre-approval. So to get to that point, the very first thing you do is you have to talk to someone like me, who's going to talk about, what you're looking to do, why now is a good time. And then you fill out a brief application. And on that application, it covers 4 main topics, right? Obviously, it's identification. I don't need to say that. But first, we're going to look at your credit, okay? And it's not just your credit score. We're looking at your credit history as well, because some people can have wonderful credit scores, but they just started building their credit, so they don't have that long term. Some people, they have credit, but they haven't had it. They've done a really good job over the past couple of years. Maybe their balances are a little bit high. Maybe there's a little boo-boo here and there because we're human and humans do make boo-boos. What we can do from there is, we analyze that and we compare it to the other 3 things that we look at to see if you qualify. So credit's number one thing we look at, though, because again, that can make or break a loan. If I see a lot of collections, if I see a lot of missed payments and things like that, I can easily say, okay, first we have to do X, Y, and Z in order to get you qualified. Believe it or not, though, with credit, you can buy a house with a minimum credit score of 580. You have to have other great things involved. So we call them extenuating circumstances. I mean, in theory, you can even go to a 500, but that's really hard to do. But 580 and above, you can buy a house. Okay. It's going to be a little bit trickier. You're probably going to have to provide more documentation, but it's not impossible. The second thing we're going to look at is your income. Okay. How much do you make? How much do you make compared to your liabilities, your debt? And when we're looking at income, we're actually trying to look at your gross income. And I call it gross because it's gross how many taxes they take out. Okay, so this is your pre-taxed income. And depending on the loan program, we can look at a debt to income ratio, which again, that's how much debt you have compared to your income, upwards of 50 to 55% of that. Okay, I don't suggest going that high because remember, that's 55% of your before taxed income. So you want to make sure the payment is still going to be doable after all your deductions, after you calculate food, things like that. Okay. Then what we're going to look at is your capacity, your assets. Okay. Now, what I mean by assets, it's going to be your checking accounts, your savings account, your investment accounts. We can look at if you have an existing real estate owned, that is an asset. Cars are even an asset, although that's a lot of paperwork to use. So unless it's like a classic, like worth a lot of money, we usually don't add that into our assets. But retirement accounts, 401k plans, IRAs, life insurance with a cash out can be used as an asset. You just have to prove in an emergency situation, you'd have access to that money. And all these things kind of add up. And we're going to look at, say, okay, do you have enough to pay for the house for your down payment and closing costs? Because remember, not only do you need a down payment, you also have to pay for something called title. There's going to be bank fees involved to pay like their processors and stuff. There's your escrow reserves and your escrow amount. That's going to be for your taxes and real estate taxes and your homeowner's insurance. All of these kind of add up and they're called closing costs. The third thing that we want to look at is, okay, after you buy the house and you pay your down payment and you pay the closing costs, do you have anything left over? We want to make sure that after closing, you can buy a cheeseburger. We want to make sure you have some reserved amounts. So typically we're looking for 1 to 3 months worth of monthly payments. But I can tell you, the more money that you show that you have in your savings, the easier the file will be because we can show, okay, great, they can afford the home, they have some savings in case of an emergency. This is going to be an easy file. The really cool thing is if you open up and you share all your details, you can get things like appraisal waivers and things like that on your loan. And appraisal waivers where we're not even going to require an appraisal. And that can save you upwards of like $600. Plus, if you're purchasing a home and you can tell the seller, I'm going to buy your home and I don't even have to get an appraisal, your offer is going to look way better than someone else who's going to require an appraisal. And that's different than an appraisal waiver on a contract. But it's basically saying for my lending needs, because you're because you either have a lot of assets, a low debt to income, good credit, whatever, we don't need to get an appraisal done. So showing assets and showing all your assets to your loan officer is key and very important because we need basically know what we're dealing with. And if you don't have enough assets, don't worry, you can probably still buy a house. There's so many great grant and down payment assistance programs out there that help a variety of people. I have a link I can send to anyone who's interested to see, okay, in the areas that they're looking to buy, what down payment assistance programs are there? The most common are your Philly First and the PHFA loans, which we are approved lender for, to really help help you get into the house if you haven't quite saved up enough yet. This way you don't have to wait. And then finally, the last thing we're going to look at is the collateral. And that's basically the house value. Now, we won't know that until we do the appraisal, but that kind of goes into how much can I afford to buy? And we calculate that based on those other three things. So that's kind of the initial part. We kind of eyeball, okay, that's your story. How much could you afford based on that information? Once we get all that squared away, we collect the documentation that prove it all. So we get your pay stubs, your W-2s. Sometimes we need tax returns. We get your identification. We verify where you lived for 2 years. We pile that into the file. We send it to an underwriter who's going to say, yep, based on what you showed me, you just now need to go find a house. We get an appraisal. We get title. Then you can close. That's called a real pre-approval. And that pre-approval, when you go to put in an offer, is also going to weigh more, because that pre-approval is going to say it's basically a commitment to buy. And from that point on, you can probably close in about 3 weeks, which is equal to about how long it takes for someone to close if they're using cash. So that's a really good combination to look at. If you are house buying right now and you've gotten beat up, get the pre-approval, because you can then get stepped up to on par with someone who's using cash, because cash buyers still want to, sometimes they still want to do an appraisal, or sometimes they still want an inspection. They can't actually, they don't go to a table with cash, by the way. They still write a check. Sometimes they have to liquefy that money to be able to write the check, things like that. So I would say definitely get the pre-approval, because it's going to arm you to be a stronger buyer in this market, and it's not going to be as hard to get your offers accepted. The next step you want to do is you want to align yourself with a really good real estate agent that you vetted. I know everyone has that family member and, cousin and, person from college that they knew that's now a real estate agent. That's great. Ask them your questions. Make sure they can answer them. You want to know, how many, if you're a first-time home buyer, how many first-time home buyers have you helped? If you're a step-up home buyer, how many step-up home buyers have you helped? This is the area that I'm looking at. What do you think of the area? Asking the right questions just makes you feel comfortable working with them. It's the biggest thing you're ever going to buy. I don't care if you buy a $50,000 house. If you buy a $50,000 house, that is still the biggest purchase you're ever going to make in your lifetime. You have to know, trust, and love the people that are helping you get into that house. So even if they're family members, I suggest, sitting down saying, okay, what's your experience with this? Here's my situation. Have you ever handled something like this? And let them make you feel comfortable working with them. If you're currently working with a realtor and you're looking to switch to a different realtor, do the same thing. You don't want to go from one realtor to the next and get stuck with the same frustrations you already have. Pretend it's like an interview, that you're interviewing for a job, and the job is to get you into a house. So that's how it should go. It should also go with your loan officer. 80% of home buyers never shop around for a mortgage. And when the CFPB, which is the Consumer Financial Protection Bureau, did a survey and found that out, they wanted to obviously ask, well, why is that? And the biggest reason is, I don't want my credit checked again. I think that's silly. So what CFPB did is they said, okay, going forward, the only credit inquiry that could affect your score while you're home buying is the first one. Then you have 30 days to have your credit checked again to pick your lender. So my recommendation is, and a lot of people are astonished I say this, but get your pre-approval, get that done. Once you have your pre-approval, once you go under contract, you may want to talk to another lender or two, just to compare and contrast. It's not always about rate. It's not always about the final number, because again, This is the biggest purchase you're going to make. You want to make sure that you're dealing with someone who's going to help you get in that house and not just be a paper pusher or not be available. That happens a lot. I'm sure everyone knows someone who has had a horrible experience getting a loan. And it doesn't have to be that bad. So just like you interview your realtor, you can also interview your loan officers. So yeah, so once you get your pre-approval, you're going to find your realtor. Your realtor is going to show you some homes. You go out to those homes, whether you visit them in the open houses or you schedule appointments. My suggestion is before you go see a house, talk with your lender and try to get an idea of how much it's going to cost. I usually tell my buyers, if you're going to go see 3 homes, I want to know all 3. And I make a nice little spreadsheet, because if you're going into the home and you see one's 250,000, one's 300,000, and the one for 300,000 has everything you want and need, I want you to be able to feel confident in making an offer right then and there. So you'll be able to see what your monthly payment would look like and what your closing costs would look like. So that's really important as well, to know your numbers prior to going. It'll help you make a determination of, should I go, should I offer more? Can I offer more? What will it look like? Because every house has a different payment, mostly because of their real estate taxes. So once you do that, we finish up the loan process, get the appraisal, goes through underwriting one more time for another clear to close. And once you're clear to close, you can breathe easy and get the keys, sign your life away on the dotted line, and then you owe the lender lots of money. But you get to move in, paint, clean, buy curtains, and buy all the furniture you want at that point. That's like a really simplified version of getting a house.
Yeah, that definitely is a simplified version. There's lots of potential anxiety points all along the way. So I echo her sentiment to make sure that you have a good team around you to make that purchase, particularly if you're first time buying a house. Do you have any particular tips for first time home buyers?
First time home buyers, yes. Make a budget. If you have never made a budget, now's the best time to do that. Write down everything that you spend money on and figure out what you're willing to give up if you have to pay for the house every single month. If you want to keep a certain lifestyle, be true to that. Don't go in it thinking, oh, well, I still want to go out every night and I still want to do this and I still want to do that. And then get pre-approved and say, oh, my budget's $1,200 a month for a mortgage payment. Okay, great. This is how much house you're qualified for. Unless you're willing to move on that budget, you're going to find out it's going to be harder to buy. So make a budget, know your budget, know your wants and needs, and know the difference. So a need is what you absolutely cannot live without, and your wants are it would be nice too. Because as a first time home buyer, remember I told you, someone's going to move. Usually they move in every 5 to 7, 10 years, or sorry, 5 to 7 years. If it's your first time buying a house, it doesn't have to be your forever home. It probably won't be. So be okay with it not having all your wants, but make sure you know what your needs are. Because you can always buy another home, keep that as a investment property. Then get passive income. Then we go in a whole nother world of fun real estate.
Well, that begs another question. Do you have any tips in this mortgage market for real estate investors?
Yeah, it's not.
What is required for what are the underwriters asking for as far as down payment days for real estate investors?
Yeah, so real estate investors, you do have to have more money. So you're going to need at minimum 20%. I would recommend 25 to 30. 25 to 30 then opens up the world of different type of loan programs where there's less paperwork. So if you're an investor, my favorite loan for an investor is the DCSR. So that's if you're going to keep it and rent it. The DSCR loan, it's a debt service loan, and it's going to be you're going to be qualified based on your credit, down payment, and the amount of rent you can get on that property. That's going to be your income. And as long as it's like at how much you're going to be able to get for the rent, that's you're basically qualified. You can also put those in LLCs, which if you're an investor, create an LLC for each one of your properties. Because if you have one LLC that you put all your properties in, if you have a liability, they can go after all the homes under the LLC. So we have a great legal representative who can help you with that. In creating the LLCs, me and Shane have worked with a wonderful lady named Nanette could help create that for you. But yeah, investment properties and investment is wonderful. If you're looking to flip, there's hard money lending that can help with the flipping. Those rates are typically very, very high. They're extremely short-term loans. We're talking 3, 6, 12-month loans, because the idea behind it is they finance the money, and the idea would be you flip it, meaning you sell it very quickly. If it's your first time doing anything like that, I don't recommend doing that, because there's a lot of stress behind it. If your first time and you have 25 to maybe 30% to put down, you can do that. You can also do something called a renovation loan through a conventional loan, which allows you to finance the cost of the repairs. But again, you still need to have a larger down payment.
Okay. We have another question here about closing costs. How are they calculated?
Closing costs, okay. So closing costs are typically, it's not really like a percentage of the loan amount. I love when people are like, oh, closing costs are 3% of the loan amount. Not necessarily, because there's so much that is involved in that. Number one, you have bank fees. Okay. Bank fees can run the gamut of being called an application fee, lock-in fee, commitment fee. That's one of the questions you need to ask when you're interviewing loan officers. How much, what are your bank fees? The other fees involved are things we have to order to get the loan done that are done by a third party that we have no control over, but you can't pick, okay? And those are going to be things like appraisal, because it has to be done through an appraisal management company. A loan officer and the appraiser has to have a middleman in between. Again, that stems from the early 2000s mortgage issues, because we're not allowed to be like, hey, can you get this value up high? Try to close. So there has to be a third party in that. So we order it through a management company who then assigns it to an appraiser, and they charge what they charge. The other fee in that is going to be any credit report fees. So we do get charged every time we run a credit report, and that then gets added onto the cost on the closing cost. So those are bank fees. Then you have title fees. Title fees are title fees. It's designed to make sure that, to simplify it, the right seller is selling the home, which, believe it or not, in Philadelphia, we have a problem with that. So we have the person who owns the home is actually the person selling it. And then the buyer doesn't have any liens and judgments against them. For all intent and purposes, the title company makes sure it's a legal transaction. And that can range between title companies in Pennsylvania. So the cool thing about title is you get to shop around for title. Most realtors and loan officers will tell you, oh, you can, but we'll just order it through our company. If you're not comfortable with that, or you want to get a quote first, by all means do that. You're 100% eligible to find your own title company and look at their fees. Most title companies are going to be identical when it comes to their fees, but there may be like little things that are different. So like they may charge a little bit cheaper for, paper doc prep services and things like that. So it is something you can shop for. For the most part, they're usually within $100 to $200 between each other. So those are the only closing costs. The second piece are prepaids. These are things that like you have to pay for. I usually say these are the things that you have to pay for regardless if you're paying for cash or getting a mortgage. That's going to be your transfer tax. So in state of Pennsylvania, it gets split between the buyer and the seller. Be careful if you're buying a foreclosure, if you're buying a new construction loan. In those contracts, they can kind of sneak it in where the buyer pays 100% of the transfer tax. And that tax is the transfer from ownership. The the other prepaids are going to be your escrow reserves. So we have to make sure we have enough in an escrow reserve to pay your real estate taxes and to pay your homeowner's insurance. If you're buying in Philadelphia, more than likely you got to come with 1 year's worth, because you got to pay back the seller what they've already paid, and then you have to cushion it for the bill that comes out in January. Outside of Philadelphia, it's a little bit more complicated because it's 2 different taxes, but we work that all out and we calculate that. And in the beginning of the loan process, not when you get pre-approved, but when you actually apply for a loan, which is when you go under contract, you're going to get a document called a loan estimate. That loan estimate is going to outline all of these fees. And in fact, that's the document you're going to use to compare lender to lender. You do not have to provide any documentation to get that loan estimate. Once you have a property, you can go to Bank A, who maybe did give you the pre-approval, get their loan estimate. You're going to go to Bank B. If they say, oh, well, give me your tax returns first, you can say, no, by law, you don't have to ask me that. I just want a loan estimate. And they have to send it to you. They may send you a draft that is not an official loan estimate, but that's going to outline all of these.
All right, good question.
That's a great question.
Any last questions before we wrap up our session for the day?
Hi.
Hi.
Mine is more personal for me, but basically to recap what you said earlier about the interest rates and how they're probably not going down any significantly anytime soon. So right now, I refinanced my current residence end of 2020 for a really good rate. However, we're looking to move into a bigger house. The prices are crazy, and of course, interest rates are high too. So I'm really hesitant to give up the good rate that I have to go to this, more expensive, higher rate. But from what you're saying, waiting it out is not really going to benefit me in the long run, because the rates aren't going down to like that level anytime.
Right. No, we're not. Now, again, I said the same thing in 2012 when they were around that same rate. I said, oh, we'll never see these again. And we did. So we don't never say never, but do you really want to take the chance of waiting 10 years to move? I assume you have a reason you want to move. Right. So
yeah,
if you wanted to, I could do a true cost of waiting for you. So again, I just did an estimate. I took a random house that was listed and did that cost of waiting. If you have a particular home or a couple homes you're looking to buy, we can do that analysis of the cost of waiting for you. So you have it personalized for yourself as well. I had a friend do this who was in the same bucket, and he loved this townhome, but he really wanted to get that single family. And I said to him, although you're paying more money, like significantly more money, let's not, let's call it what it is, a significant difference. Will it give you a peace of mind being in the home? That's why I like to know someone's why, because that's a big determination on if it's going to work or not and be worth it. Because if you can't find peace where you're at, but you have all the savings in the world, but you're not happy, you're not satisfied, like it's causing you stress where you can't go the next step. Like you got to look into, okay, that's where you weigh your budget. Is it worth paying this so that for 2-3 years we have peace of mind? We love this house. Sucks we have to pay this extra money, but is it nicer to be in it? And also keep in mind, you are paying that extra money, but income is actually increasing across the board. So people are making more, which is also why this is a whole really, really weird high inflation recession. It's very strange. People are actually making more right now. And you're gaining that equity. It's not like that money's getting thrown away on a landlord. Like, as you know, you've paid money on this home for 2 years, that money went to something. You're just transitioning it. Think of it that way. You're moving this money into the home to sit in there and appreciate at a 2 to 3, depending where you are, might be 4% interest rate. Think of it that way. And that might justify it a little bit more for you. But again, to know your personal story, I would love to help you. So if you want to take this offline, I can, run some personal and really tailor it to you.
Yeah, thank you.
Absolutely.
All right. Any other questions before we close out for the day? And Paula, certainly you'll make yourself available if anybody wants to talk more specifically about applying for home loan, refi, all of that good stuff.
I'm
I'm
putting my
certainly available to walk anybody through this process who is planning to buy and wants to run some numbers, wants to look at the big picture of your finances, because you certainly want to do this in conjunction with your overall financial plan and not be house poor. So
Yes.
think about the life you want to live, not just the house you want to live in, and make sure that everything is affordable. So that is something that I can do as an advisor. And thank you so much, Paula, for doing this. I learned something new, so I hope everybody else learned something new as well. I learned a couple of things new, which is why it's good to have actual experts on these topics. So I consider myself a generalist in a lot of areas, but a generalist is not a specialist. So investments, I know. Mortgages, I'm like, yeah, I got enough, right?
Right,
But I
exactly.
do partner with people who know a lot more than I do, and give my clients access to those individuals to make sure that you get the best information possible. So thank you for joining us today. If you're watching the replay, Paula did put her information out in the chat, but you can always get in touch with me to ask me to get in touch with her if you are interested in having that cost of waiting analysis done. In light of that, thank you again. I'll give you back your day, and we will look forward to seeing you on the next Insight Education Series. Have a great
Thank you.
afternoon.